What if I told you that investing $1,000 a month for the past 30 years in a fund tracking the biggest names in tech could have hypothetically grown to over $21 million? It sounds like a fantasy, something completely out of reach for the average person. But what if I told you it was based on the real historical returns of the market? Stick with me, because today we're not just talking about an investment. We're talking about a vehicle for owning a piece of the future, and we're going to pop the hood and look at every single part of the engine. We are going to be taking a deep dive into an investment that I believe is one of the best-kept secrets for savvy, long-term investors. The Invesco NASDAQ-100 ETF, ticker symbol QQQM. We're not just going to talk about its performance, we're going to dissect it. We'll look at the exact companies you're buying, the precise weightings of those companies, and the specific sector loadings that give this fund its unique growth-oriented personality. Then, we will run the numbers to see how this specific recipe could have hypothetically turned a consistent monthly investment into a life-changing fortune, and what that could mean for your actual retirement. So, let's start with the basics. What is QQQM? It's an exchange-traded fund, or ETF, designed to do one thing and do it exceptionally well. Track the performance of the NASDAQ-100 index. This index is a collection of the 100 largest and most actively traded non-financial companies listed on the NASDAQ stock exchange. For years, the go-to fund for this was the legendary QQQ, but in 2020, Invesco launched QQQM as a more refined version for buy-and-hold investors like us. It tracks the exact same index, but it does so with a lower expense ratio, 0.15% versus 0.2%, and a more modern structure that allows for the automatic reinvestment of dividends, a critical component of long-term compounding. But the real question isn't just what the fund is, but what's in it. When you buy one share of QQQM, what do you actually own? This is the most important part. Think of it like buying a world-class sports car. You don't just care that it's fast. You want to know what kind of engine it has, who made the components, and how it all works together to create that speed. Let's lift the hood on QQQM. The first thing you need to understand is that it is a market capitalization weighted index. That's a fancy way of saying the biggest companies, based on their total stock market value, take up the biggest positions in the fund. This means a handful of giants have an outsized influence on the fund's performance. As of late 2025, the top 10 holdings in QQQM make up over 50% of the entire fund. This is a feature, not a bug. It's a fund built on the idea that winners tend to keep winning. Let's meet the titans at the top. Powering into the #1 spot is Nvidia Corp with a massive 9.66% allocation. Once known for gaming graphics cards, Nvidia is now the undisputed leader in producing the high-powered chips that are the engine of the entire artificial intelligence revolution. It's truly the company providing the shovels in a digital gold rush. Right behind it are the two companies that have defined the tech landscape for a generation. You have Microsoft, the software and cloud computing backbone of the professional world with its dominant Office suite and its massive Azure platform. Then there's Apple, a cultural and financial juggernaut that has created a powerful and sticky ecosystem of hardware and services that billions of people use every single day. Next in line is another semiconductor powerhouse, Broadcom, a critical designer and manufacturer of a wide range of chips that are essential for everything from smartphones to data centers. Then we have the king of e-commerce and cloud computing, Amazon, which is not only the everything store, but also a dominant force with its Amazon Web Services platform. Following that is the social media giant Meta Platforms, the parent company of Facebook, Instagram, and WhatsApp, which connects billions of users and is a titan of digital advertising. Next, you get a double dose of the undisputed king of search and online video, Alphabet, Google's parent company, with both of its stock classes in the top 10. Then there's the company that revolutionized the automotive industry and made electric vehicles mainstream, Tesla. And rounding out this incredible list is Netflix, the company that single-handedly changed how the world consumes entertainment through its pioneering streaming service. So when you buy QQQM, you are making a heavily concentrated bet on these 10 specific names to lead the market forward. Their collective success or failure will have a direct and significant impact on your investment returns. Now, let's zoom out from individual companies and look at the sector composition. This is crucial for understanding the fund's personality and risk profile. Based on the latest data from June 2025, QQQM's allocation is a powerful, focused bet on the future of the economy. The biggest slice of the pie, by an enormous margin, is the technology sector, weighing in at a colossal 60.84% of the fund. This is the heart and soul of QQQM. This is where you find your software companies, your hardware and equipment makers, and, most importantly, the semiconductor companies like NVIDIA and Broadcom. This massive weighting in tech is the primary reason for the fund's explosive growth potential, but it's also the source of its volatility. The second largest sector, and a distant second at that, is consumer discretionary at 19.44%. This sector is comprised of goods and services that people want but don't necessarily need, making it a direct bet on consumer confidence. The two heavyweights driving this allocation are Amazon and Tesla. When you combine the technology and consumer discretionary sectors, you get over 80% of the entire fund. This is an incredibly concentrated bet on these two areas of the economy. After these top two, the sector weights drop off a cliff. The next largest is healthcare at just 4.82%. But this isn't your grandparents' healthcare sector. It's often innovative biotech and medical device firms. Following that, we have industrials at 4.35%, telecommunications at 4.30%, and consumer staples at 2.62%. At the very bottom, you have tiny slivers of the old economy sectors: basic materials, utilities, energy, and real estate. But just as important as what's in the fund is what's not in it. The NASDAQ-100 explicitly excludes financial companies. That means you own 0 shares of banks like JP Morgan Chase, Bank of America, or investment firms like Berkshire Hathaway. You also have virtually no exposure to traditional energy companies like ExxonMobil or Chevron, or to utility companies. The fund is purposefully tilted away from these old economy value sectors and is hyper-focused on the growth sectors of the new economy. This concentration is a double-edged sword. It's the source of its incredible potential returns, but it also means that when the technology and growth sectors fall out of favor, QQQM will likely underperform the broader market, like the S&P 500, which is much more diversified across all sectors of the economy. You are making a concentrated bet on innovation. So now that we've thoroughly examined the engine, let's talk about the performance this specific collection of companies has delivered. For our examples, we will use the 10-year average annualized total return of the NASDAQ-100 index, which, as of late 2025, was approximately 19.67%. This is a historical figure from an extraordinary bull market for technology. Let's start with $500 a month. That's about $16 a day. After 20 years, with a monthly investment of $500, your portfolio could have hypothetically grown to approximately $1,490,000. You would have personally invested $120,000 over those 2 decades. The rest, nearly $1.4 million, would be the result of compounding growth from this specific basket of innovative companies. If you extend that timeline by just 10 more years, the power of that high growth rate becomes truly mind-boggling. That same $500 a month could have hypothetically grown to over $10.7 million. Your total contribution would be $180,000. That is the magic of long-term, consistent investing in a high-growth index. Now, let's up the ante a bit. What if you could find a way to invest $750 a month? After 20 years, at $750 a month, your portfolio could have reached over $2.2 million. Your personal investment would be $180,000. And after 30 years, you're looking at a potential portfolio value of over $16.1 million. Your total contribution would be $270,000. All right, for our final example, let's look at investing $1,000 a month, the number we teased at the beginning. After 20 years, investing $1,000 a month could have led to a hypothetical portfolio of nearly $3 million. Your total investment would be $240,000. And if you maintained that $1,000 a month investment for 30 years, based on those past returns, you could be looking at a portfolio worth over $21.5 million. Your total contribution would be $360,000. Take a moment to let those numbers sink in. These are not lottery winnings. This is the hypothetical result of a simple, disciplined process. Consistently buying a low-cost fund that holds a concentrated portfolio of some of the most successful companies of the last generation. Now, accumulating a substantial nest egg is one thing, but what does this actually look like in retirement? How do these large numbers translate into a comfortable and secure lifestyle? Let's use a common rule of thumb in retirement planning, the 4% rule. This rule suggests that you can safely withdraw 4% of your portfolio's value every year for retirement. Let's apply this to our 30-year hypothetical scenarios. With the $500 a month plan resulting in a potential $10.7 million portfolio, a 4% withdrawal would give you an annual income of over $428,000, or about $35,700 a month. This is an income that provides for more than just needs. It provides for dreams, travel, and immense generosity. With the $750 a month scenario and its $16.1 million portfolio, you'd be looking at an annual income of over $644,000. That's nearly $54,000 a month. This level of income provides absolute financial freedom to pursue any passion without financial constraint. And with our $1,000 a month example, a 4% withdrawal from a $21.5 million portfolio would generate an annual income of $860,000, which is a life-altering $71,600 a month. This is more than just retirement income. It's the kind of wealth that can provide a legacy and opportunities for generations to come. The journey to financial independence is a marathon, not a sprint, and understanding exactly what you're investing in is paramount. For those who believe in the long-term power of technology and innovation, and who are comfortable with the inherent volatility of a concentrated, growth-focused strategy, QQQM is a phenomenal tool. It gives you a direct, low-cost, and efficient ownership stake in the very companies that are building the future. The examples we've looked at today are, of course, based on historical data. The future is never certain, and the market will have its ups and downs. But the principle remains the same. Understanding your investment, being consistent, and staying disciplined over a long period of time is a time-tested strategy for building significant wealth. Don't let the big numbers intimidate you. The most important step is the first one. Start with what you can afford, automate it, and let the power of these incredible companies work for you over time. I hope this deep dive has been helpful and has inspired you to look under the hood of your own investments. Want to learn about the most popular ETF in the world that could help you retire early earning $190,000 per year? Click right here.